Welcome to Livewire's Fund in Focus. My name is Vishal Tekshalani, and today we're putting the Epsilon Direct Lending Fund into the spotlight. Joining me is Joe Millward, founding partner of Epsilon Direct Lending, and he's going to discuss where this strategy fits into a portfolio. Joe, it's so great to have you here.
Thanks for having me.
Of course, no worries. So Joe, can you introduce the Epsilon Direct Lending Fund? What is its core objective, and what types of investors is it designed for?
Sure. So it's a wholesale fund, so it's only available for wholesale investors. It's an open-ended fund, so that means that we take applications every month and we continue to invest investors' capital. And what we're investing in, performing medium-sized companies, and we're lending to those companies to support their growth. To support acquisitions, to support expansions into new products and geographies. We're a corporate lender and we're a direct lender. And what that means is that we're lending directly to the company, typically on a bilateral or one-to-one basis. So we're in control of the structuring of that loan from the origination of it all the way through to the repayment of it, having executed and then heavily monitored the performance of the company through its life.
And what's the objective?
Yeah, so the objective of the Direct Lending Fund is to deliver our investors a net return of the swap rate, the 3-month BBSY rate, plus 6% per annum. That's our aim, that's our investment objective. And what we seek to deliver investors is recurring, predictable income. We collect our interest from our borrowers and pay that on to investors every quarter, targeting the net return that I just mentioned. And we try to achieve a style of investment that isn't correlated to other asset classes.
Okay, help us understand the way you construct the portfolio. What can investors expect in terms of how many loans, position sizing, etc.?
As a control lender, as a direct lender, we stay very close to our portfolio companies. Some people have referred to it as private equity style, private credit, where we're really hands-on in supporting the growth of a company and truly understanding their intrinsic value, what makes their cash flow sustainable and predictable. And so because of that, we target a reasonably concentrated portfolio. Right now we have 17 loans in our fund that will grow through time. What we won't become is a beta style fund that has hundreds of loans, because if we had hundreds of loans, Vishal, I wouldn't know the names of the CEOs and I wouldn't quickly recall what it is every single company does and how they make money. I wouldn't be able to scale my investment team to truly keep a hands-on role, and so that's not our investment style. We're a control lender, a direct lender, and we're really proud of having a highly selective portfolio of relationships with really strong performing corporates across Australia.
Okay, so Joe, your focus area is the middle market, and you focus exclusively on Australia and New Zealand. Why middle market? Why the Australian and New Zealand focus?
Sure, so why middle market? Small companies, it's riskier to lend to them. If you've got an operator of a milk bar or a business that's only occupying a single state with a much more discrete customer set and supplier set, the financial risks of lending to them are far greater. At the larger end of town is a highly competitive market segment, and our investment philosophy is to focus on underserved segments of our economy. We believe the middle market is underserved because it doesn't allure the big investment banks with the big fees that they seek to charge because the companies aren't big enough to pay them, but they're not so small that they run significant credit risk when lending to them. So we love the middle market for those reasons. It's a deep, diverse segment of our economy that is critical. You and I, every single day, we use their goods and services every day.
And why Australia?
Yeah, so why Australia? Well, our investment philosophy is to focus on underserved segments of the market. In Australia, the middle market is underserved. In New Zealand, the middle market is underserved. If you stray offshore to mainland Asia, you introduce significant credit risk because the lending jurisdictions are far more complex. It's harder to recover your money. The insolvency regime in Australia is creditor friendly. It's a great place to lend if you're a senior secured lender. So we like Australia for those reasons. We also don't focus on the US and Europe. They're oversupplied segments. If you're a borrower, you'll get 20 term sheets from private credit funds seeking to support your next acquisition because it's a highly competitive marketplace. And that means that those private credit fund investors are exposed to things like covenant-light lending and compressing yields. It's because there are so many competitors seeking to lend the same money. We don't think that's attractive for investors, so we're focused on our home turf.
So Joe, risk management is a key concern for private credit investors. How does Epsilon approach risk management to ensure that you're generating attractive returns, staying away from problematic borrowers and not having too much volatility within the portfolio?
Sure, we lend to the performing corporate segment of the Australian middle market. So that means we're looking for sustainable, predictable earnings, at least $5 million of earnings, $15, $20 million of earnings comprises the middle market segment. And so when we're originating the loans, we're really looking for asset selection criteria that meet those investment parameters. When we execute the loans, we're looking for really high quality financials from a company, typically audited, typically with a long-term position in the market that they occupy. Most of our companies have been around for 20, 30 years doing what they do. So we're looking for those characteristics, all to be supported by financial, legal, tax, commercial due diligence from top-tier providers. A typical investment paper, when we write one, is about 50 pages long, supported by about 1,000 pages of due diligence, and that will include site visits, that will include meeting management, customers, employees, going to kick the tires of the firm. So that's the execution part of the loan. When it comes to portfolio management, that's looking after the existing exposures that we already have. We're getting the monthly P&Ls, cash flows, and balance sheets and commentary from the company. So we've got a finger on the pulse of their performance. Whilst we've got very large buffers in place, when we lend, we're typically only accounting for the most secure part of the capital structure to the tune of around 40%. The other 60% is equity capital that's being contributed in cash when buying a business. Whilst that's the case, we like to stay very close to the company's performance because deterioration in that performance can lead to heightened risk of default and ultimately impairment. And so every single month we sit down as an investment committee, we inspect the monthly financials of all of our portfolio companies, and we effectively re-underwrite our risk position. We ask ourselves what's changed about the company, and we're straight on the phone to the management team and the owners to say, hey, what's up here? We've seen a bit of underperformance, and if that continues, in a year's time, there might be a covenant breach. And let's talk about that now and be super proactive about portfolio management.
So Joe, can you walk through the key features that investors should know about? I think we covered your target yields earlier in this conversation, but what's the target total return, distribution frequency, availability of the fund?
Target net return to investors is swap plus 6. The swap rate is BBSY. So it's set every 3 months. Right now that's sitting at just over 4%. So our total net target return right now is just north of 10% per annum, and we pay that quarterly. We consider redemptions every quarter end as well. In some instances there's a lock-up period that applies, in others there isn't, subject to the type of investment that's made. Monthly pricing, monthly applications are accepted, and we build up that capital in order to deploy loans and seek to generate our target return to investors.
Okay, do you want to touch on availability? How can advisors, etc., access it?
Yeah, sure. So advisors can access our fund directly. We accept direct investments from wholesale qualifying investors. We're also available on a number of private wealth platforms, platforms such as NetWealth, Hub24, Praemium, PowerWrap. We're on all those major growth platforms.
Okay. And lastly, Joe, let's talk about evaluating between different private lenders and private credit funds. So we've seen this area become quite popular. How should investors weigh, say, for example, Epsilon's capabilities versus another private lender? What are the key things to look for?
Yeah, well, one of the key things, and it's a motto that we use extensively at Epsilon, is that cash is king. Assets, their intrinsic value is defined by the cash flow that they can sustainably and predictably generate. And in our instance, when we lend to companies, we charge them an interest rate, and the vast majority of that interest rate is paid to us in cash every quarter end. Companies can do that when we lend to them because the companies we're lending to are performing corporates that are generating sustainable, predictable cash flows. That's what we underwrite. So what investors will see when they receive our quarterly return is that 96% of the cash we pay them is cash that we're receiving every single quarter from investors. We think constituents of return in private credit is something that's under-diligenced or underappreciated. If the return is all cash, the risk of volatility, private credit's meant to be a low volatility return profile product in most instances, the volatility will be lower because you get the cash and you pass it on. If your returns are comprised of constituents such as capital gains, if private credit managers are marking up the value of a warrant, an equity warrant, or the value of the loan, or if they've taken equity in a business, the value of their equity, before that is realized in cash, You're introducing tail risk in your fund returns. That capital gain component of what's being distributed in cash might unwind in future months. You can also have returns that are driven by leverage that's employed by funds. So part of your return constituent might be a levered component of your returns. All of those factors introduce risk, and we're not focused on generating those types of returns. We're generating cash returns for our investors.
Okay. Joe, thank you so much for your time.
Thanks.
I hope you enjoyed this episode of Fund in Focus. Please don't forget to give this video a like and subscribe to our channel so we can bring more opportunities like the Epsilon Direct Lending Fund to you. My name is Vishal Tekshanani. Happy investing.